What's up guys, Kieran here and you're very welcome to this video on how to invest in stocks. In this video I'm going to break down stock investing 101 and give you the knowledge and the information you need to start your investing journey and get on the path to financial independence. I'm also going to outline 3 mistakes that new investors make so that you don't have to make them. As always, if you get value from this video, please hit the like button and subscribe to the channel. With that being said, let's get straight into it. As Charlie Munger says, talking about the economy and making predictions is the same as taking a piss down your own leg. It might feel warm and hot to you, but it doesn't affect anybody else. So what is a stock? Well, a stock can also be called a security or equity or a share, and essentially it's a legal part ownership in a business. And as part owner, you're entitled to a proportionate share of the company's profits or losses. So a company will go public to raise capital to fund new growth, and a company will do what's called an IPO, which is initial public offering, and they will offer shares of their business to the public. The number of shares the company offers multiplied by the value of each share is what we call the market capitalization. So market capitalization is essentially the price you would pay for the business if you bought it outright. Market capitalization is an important number because it's a good predictor of the level of risk associated with a business as well as its growth potential. So for businesses with large market caps, you can't expect to see huge levels of growth, whereas small cap businesses tend to have lots of room left to grow. On the other hand, large market cap businesses are generally considered less risky than small caps due to the fact that the businesses are so well developed. So we tend to divide businesses by market cap and into the following buckets. Micro cap, which is anything less than 250 million. Small cap then is 250 million to 1 billion. Mid cap then is 1 billion to 10 billion. And large cap is anything over 10 billion. While market capitalization is a useful number to get a feel for the growth potential and the risk associated with the business, it's not an accurate predictor of either. It's more of a broad generalization. It's also the price you would pay for the company if you were to buy it outright. But it's very important to note that it's not actually what the business is worth. This is what we call its intrinsic value. And it's very important to distinguish the two, because this is where a lot of new investors get caught out. A prime example of it would be the dot-com bubble, where tech stocks were priced at crazy levels, way above their intrinsic value. Of course, investors that paid these prices ended up losing either a lot of money or all of their money. And while the dot-com bubble is an extreme case, we see inflated and deflated prices in the stock market every day. So we determine intrinsic value by estimating the future cash flows of a business. And this is a number that can only be estimated, as nobody can actually predict with 100% accuracy the future of any business. But before you consider buying shares in a company, it makes good sense to have an estimate for intrinsic value. You always want to make sure you're getting the best deal for your money. For instance, if you were to go and buy a used car, you'd look around online to make sure that what you were paying was what the car was actually worth. And then you'd go and inspect the car, you'd kick the tyres, you'd look under the bonnet. So why wouldn't you do the same when buying a company? Investing in stocks is a fantastic way to grow your wealth. But we all know people who, based on some tip from a co-worker or a friend, invested in some company and ended up losing all their money. We also all know people who, lost either most of or all of their pensions in the global financial crisis of 2008. So it is scary stuff, and I don't blame people for being nervous. If anything, you should be cautious. As Warren Buffett says,
the first rule in investment is don't lose. And the second rule in investment is don't forget the first rule, and that's all the rules there are.
In most cases where money is lost, people either took on too much risk or they made poor uneducated decisions. Generally, these decisions were made out of fear. Firstly, they make decisions out of fear of missing out. So when they hear the media talking about the great bull run or the fact that Bitcoin's going to 1 million, they look at stock prices and they see them going up and they buy in because they're afraid that they're missing out. When you buy because you're afraid of losing out, you've already lost. You've made a decision based on emotion and fear instead of facts and instead of consideration to the actual intrinsic value of the business that you're buying. Secondly, they make decisions out of fear of losing money. So when the stock market goes into a decline, they sell because they're afraid of losing. But essentially what they do is they lock in their losses. Again, they're making a decision out of emotion and fear instead of actually consideration to the intrinsic value of what they're selling. If these people read even one good book on investing, they would know that they're making the most basic of mistakes. Even those who don't make active buying or selling decisions usually end up underperforming the market. One of the big reasons is that they put their money into mutual funds that charge exorbitant fees but still underperform the market. To put things in perspective, the stock market goes up and it goes down, but it goes up far more than it goes down. This is made possible because technology continues to grow, populations continue to grow, and countries which are not developed continue to become developed. All this means more consumerism and more growth in productivity. So to conclude the original question, is it safe to invest in stocks? Well, yes, it is, but you do need to educate yourself. One of the most important learnings for a new investor is that you should not fear a crash. You should actually embrace it. So a correction or a crash is when the market falls by 10% from its peak. When a market falls more than 20% from a peak, it's what we call a bear market. On average, corrections happen once a year, and less than 1 in 5 of them actually turn into bear markets. They can be scary, and the media will try and convince you that the world is ending. But it doesn't, and the show goes on. Bear markets can look like massive drops at the time. Just take a look at the dot-com bubble or the global financial crisis. But when you take a long-term perspective, you realise that they are short-lived and that they don't really matter so much over the long term. And the fact is that the market has far more up years than it has down years. In fact, instead of being afraid of a crash, you should really hope for one. You see, during a crash, investors turn really pessimistic, which means that prices go much lower. Historically, big crashes are then followed by periods of massive optimism, where prices are driven higher. This cycle is what Howard Marks calls the pendulum of investor psychology, and this cycle repeats itself over and over again. If you were to be a truly great investor, then it's during the crash where you separate yourself from the average investor. This is your opportunity to buy what's cheap. When the average investor is selling out of fear, you are buying out of greed. So passive investing is where you invest in a diversified low-cost index fund. You don't make active buying and selling decisions the same way an active investor would. But considering that most active investors fail to beat the market anyway, passive investing is the best approach for most people. So to explain what an index fund is, I have to first explain what an index is. So a financial index is a tool used to track the performance of a group of stocks or a particular market sector. The most common and most familiar one would be the S&P 500, which tracks essentially 500 large cap companies on the US stock market. And is famously used to measure the performance of active funds against, or to measure the overall performance of the US stock market. By comparing an actively managed fund to an index, you get a very good idea for how much value the fund managers are actually adding. An index fund, on the other hand, is an investment fund that doesn't make active buying or selling decisions. Instead, it essentially mirrors an index. So you could buy an index fund which mirrors the S&P 500 index. And essentially what it would do is just buy and sell stocks as they go in and out of the index. It doesn't actually make any active decisions. The advantages of index funds include instant diversification, low fees. They're ideally suited for passive investors who want to invest over the long term for the likes of retirement. And they offer consistent and often predictable returns. A mutual fund, on the other hand, is a fund which is actively managed, and the managers make active buying and selling decisions to try and either beat the market or offer lower levels of volatility. However, what you pay for with mutual funds is often not what you get, because 92% of actively managed funds failed to beat the S&P 500 over the last 15 years, and 85% of them failed to beat it over the last 10 years. To say that's dismal performance is an understatement. A 2013 study by Dalbar shows that the S&P 500 returned 11% over 30 years, while the average investor who invested in mutual funds returned only 3.7%. That's a massive 7.4% difference annually. And to put that in perspective, if you invested $100,000 in 1984 in the S&P 500, 30 years later you would have $2.3 million. On the other hand, the average investor who invested in mutual funds had just $296,000 after the same 30-year period. Now, I'm not sure if this difference is down to the fund themselves or investors pulling their money in and out of the funds at the wrong time, but it makes a really strong case for just investing in passive index funds. Now, I'm not saying that index funds are for everybody, but they are for most people because they offer instant diversification, they charge very low fees, most people can't beat the market anyway, so they might as well just join it. They require much less buying and selling, which means lower brokerage fees. It's worth noting though that for investors who want to earn higher returns, they will need to take an active approach. A word of warning though, if you're not willing to put the time in or you don't have the right aptitude, you're just going to end up underperforming the market anyway, so it's a complete waste of time. For active investors, the potential return is higher, but so is the risk. So you don't need to be in Mensa to be a great investor. In fact, intelligence can be more of a hindrance if you don't have the right temperament. Investing is far more about managing your emotions than it is about intelligence.
Warren, what do you consider the most important quality for an investment manager?
It's a temperamental quality, not an intellectual quality. You don't need tons of IQ in this business. I mean, you have to have enough IQ to get from here to downtown Omaha, but you do not have to be able to play three-dimensional chess or be in the top leagues in terms of bridge playing or something of the sort. You need a stable personality. You need a temperament that neither derives great pleasure from being with the crowd or against the crowd.
There's loads of information out there explaining how you are likely to feel in any given situation and the correct response, which is usually the opposite of your gut instinct. Great investing is a matter of learning from the greats and simply applying your learning instead of panicking and freaking out and doing the opposite of what you've been warned not to do. It doesn't sound too difficult, does it? Well, it's not. And here are 3 common mistakes that you don't have to make. A lot of people lose money in the stock market, but a lot of people have no business making investment decisions because they don't even know the basics. Historically, the markets have always gone up over the long term, so there really is no excuse. The problem is that most people don't actually invest. Instead, they speculate. There's a key difference between investing and speculating. Investing looks at the underlying fundamentals of a business to try and understand the future cash flow potential. And when the future cash flow potential is worth more than the current price of the business, smart investors buy so that they can enjoy the growth ahead. Speculating, on the other hand, is just guessing. Speculators believe that the share price is going to keep going up without having completed any fundamental analysis of the business. Sometimes they're right and sometimes they're wrong, but when they're right, it's always just luck. Speculating is usually short-term focused, and a perfect example would be buying a stock because the share price recently shot up in value and you assume that past performance is a predictor of future performance. Investing, on the other hand, is buying it because you did a fundamental analysis of the business and you believe that it's currently priced below its intrinsic value. One is guessing while the other is investing. Another example of speculating is jumping in and out of an index fund because you're trying to time the market. Investors don't try and market time because they don't try and predict what's unpredictable. Another mistake that new investors make is paying high fees for mutual funds. As I mentioned, most mutual funds fail to beat the market anyway, but the high fees they charge is probably one of the biggest reasons for this. If you buy into a mutual fund and it charges 2% fees a year, it doesn't matter whether the fund loses money or makes money, you pay your fee no matter what. So for example, if the mutual fund lost 7% returns in a year, you'd still pay your 2% fees on top of that, essentially costing you 9%. The fund manager gets paid no matter what, no matter whether they deliver a return or they don't. There are so many low fee options available now that unless you're getting a really specialised service, you just find it very hard to justify paying the high fees for a mutual fund. In a world where we associate price with value, most investors are fooled into thinking that paying a higher price for something will deliver more value, but this couldn't be further from the truth. The data doesn't lie, and the data shows that the majority of funds fail to outperform the market. If you're to be a good investor, you need to let data drive your decisions and not emotion or fear. So another big mistake that new investors make, which I alluded to earlier, is that they try and time the market. They listen to the financial media, which is driven out of scaremongering essentially, and they think that the crash is coming, so they sell their position. Now what usually happens is there is no crash, and they miss out on years and years of great returns. Eventually they buy in out of fear of missing out, and the inevitable happens. The crash comes. The media wants you to believe that they know what's going to happen. They want you to believe that by listening to them, you'll be informed enough to make decisions about what's going to happen. But nobody can predict what's going to happen in the economy. As Charlie Munger says, talking about the economy and making predictions is the same as taking a piss down your own leg. It might feel warm and hot to you, but it doesn't affect anybody else. Every year the media makes bold predictions, and every year they're wrong. Eventually when they're actually right, it's purely out of luck. One of the greatest examples of investors being their own worst enemy is the Magellan Fund ran by Fidelity Investments. So the fund was actually managed by Peter Lynch from 1977 to 1990. And during his tenure as fund manager, Peter returned 23% annually. Peter turned every $1,000 invested into $28,000. But do you know how the average investor fared out investing in the Magellan Fund? Well, according to Fidelity themselves, the average investor actually lost money. That's right, the average investor lost money in the Magellan Fund when the fund itself returned a staggering 23% annualized returns. The reason the average investor lost money is because they were trying to time the market and they were going in and out of the fund. Many index investors do the same thing when they invest in index funds. They try and time the market and they just end up underperforming the fund itself. Okay guys, so if you're still with me, then congratulations, because you clearly have the patience to be a great investor. Investing can be overwhelming at the start, and people are easily fooled by investing professionals into thinking that they can't achieve the same results as paid money managers. And this couldn't be further from the truth. I implore each of you to get to grips with your own finances and investment choices. After all, it's your own future and nobody is better equipped to manage it than yourself. As always, if you got value from this video, then please hit the like button and please subscribe to our channel. We're a brand new channel and we would really appreciate your support. Also, make sure to hit the notification button so that you get notified when we release new content. Thank you so much for watching and have a lovely day.